Let's start with a simple truth. Markets are noisy, wildly unpredictable, filled with emotion, bias, and illusion. Yet hidden inside that chaos lies structure, faint but persistent. The trader's job isn't to predict the future, it's to decode that structure, to find the patterns that quietly repeat when everyone else is distracted by noise. Thinking like a hedge fund trader means thinking probabilistically. It means accepting that we'll never be right all the time, but we can be consistently less wrong. The edge doesn't come from passion, instinct, or even intelligence. It comes from measurement, iteration, and the courage to trust your data more than your gut. Markets have a strange way of seducing people. They lure with the promise of fortune and the illusion of control. Most approach them as gamblers, others as prophets, and a few as scientists. The difference is subtle but crucial. The first two chase outcomes. The last one chases understanding. The majority look for predictions, guesses about what will happen next. The minority, however, look for patterns, repeatable structures that emerge through time, obscured by noise but stubbornly persistent. Thinking in terms of patterns rather than predictions changes everything about how you approach markets, and indeed how you approach uncertainty itself. A prediction assumes knowledge of the future. It's an act of confidence, often misplaced, that something will happen because you feel it, or because you think you've read the signs correctly. A pattern, on the other hand, is humble. It doesn't demand that you know what's coming. It only suggests that certain configurations of events have tended to lead to certain outcomes more often than chance would allow. The trader who works from patterns does not claim omniscience. They claim probability. The difference between prediction and pattern recognition is the difference between speculation and science. Prediction is fragile. It relies on being right once. A pattern is robust. It relies on being right often enough. One cracks under randomness. The other is built to absorb it. In markets, randomness dominates almost every moment, every tick of price, every swing of sentiment. To survive, you cannot anchor your thinking on the illusion of certainty. You must build systems that thrive in uncertainty, and that begins with the pursuit of patterns. Finding patterns, however, is not about staring at charts until you see what you want to see. It's not about drawing lines, circles, and waves. It's about data. Large, messy, uncooperative data. It's about measuring, testing, and quantifying relationships that the human eye might never notice, but that mathematics quietly reveals. Most of the time, these relationships are small, margins of 1%, 0.5%, sometimes less. But if you can identify a small edge that persists across thousands of opportunities, it becomes a machine of compounding precision. The most dangerous thing in markets is conviction without evidence. Many people believe they can feel the market, that intuition will guide them. Intuition is useful in structured environments, where feedback is immediate and stable. Markets are neither. They are adaptive, deceptive, and chaotic. Your brain evolved to detect patterns in a world of survival, not in a world of high-frequency price movements and nonlinear correlations. What feels like intuition is often bias wearing confidence as camouflage. That is why quantitative traders turn to data, not emotion. The goal is not to remove the human element, but to discipline it, to confine it within systems that measure rather than imagine. Every idea, every signal, every hypothesis must face the same test. Does it work repeatedly? If it works today and fails tomorrow, it is noise. If it survives thousands of iterations, if it persists across regimes, across volatility shifts, across time zones, then it might be a pattern worth trusting. But even then, humility remains essential. Markets evolve, patterns decay, edges erode. The discovery of a pattern is not the end of the process, but the beginning of refinement. Once an anomaly becomes known, it begins to vanish. Capital flows toward it, arbitrage closes it, and what was once an advantage becomes equilibrium. The trader who thinks in patterns must therefore think dynamically. The goal is not to find one eternal truth, but to continuously map transient truths as they emerge and fade. The real art lies in differentiating between randomness and repeatability. The human brain, in its hunger for order, will see patterns where none exist. A phenomenon known as apophenia, a streak of winning trades, a series of correlated price moves, a coincidence that feels meaningful. These can easily fool even the most rational mind. That's why you must never rely on what looks right. You must rely on what tests right. The market rewards the empiricist, not the dreamer. Pattern recognition in trading is not about prediction, it's about conditional probability. It's not saying the market will rise tomorrow. It's saying, given this configuration of events, the market has historically risen 60% of the time. That is not a prophecy. It's a statistical tendency. The difference is profound. It reframes your relationship with uncertainty. You stop trying to control outcomes and start managing probabilities. You stop asking, what will happen? And start asking, what is likely to happen and what will I do if it doesn't? When you think this way, trading becomes a form of experimental science. Each trade is a data point. Each result feeds back into the model. Failure is not punishment. It's feedback. Success is not validation. It's verification. The process is iterative, a loop of observation, hypothesis, test, and adjustment. The reward is not in the single winning trade, but in the accumulated insight of 1,000 small, disciplined decisions. This mindset demands patience and detachment. It requires comfort with uncertainty and respect for randomness. It rejects the drama of the trading floor for the quiet precision of analysis. It values repeatability over excitement. The best traders are often the least emotional, not because they lack passion, but because they've learned that emotion clouds judgment and magnifies noise. Patterns are subtle because the market is adversarial. Every visible pattern attracts attention, and every crowded trade eliminates its own advantage. The richest patterns are often hidden in places others dismiss as irrelevant. They may emerge from alternative data, shipping routes, weather trends, credit card transactions, satellite images, social sentiment, or they may arise from relationships between assets that seem unrelated. Currencies and commodities, volatility and volume, seasonality and macro cycles. To uncover them, you need a mindset that merges curiosity with rigor. Curiosity to ask, what if? And rigor to test, does it really work? You must think like a mathematician and act like an engineer. The discovery process is creative, but the implementation is mechanical. Creativity without structure produces noise. Structure without creativity produces stagnation. The magic lies in their intersection. The phrase patterns over predictions extends beyond finance. It applies to every field that deals with complexity. In life, as in markets, people are drawn to bold forecasts, confident voices that claim to know the future. But history shows that humility and data-driven reasoning outperform confidence in the long run. The most reliable path to understanding is not through certainty, but through curiosity disciplined by evidence. Consider how this philosophy scales with time. In the short term, markets appear random. In the long term, structure emerges. The noise cancels, the patterns persist. But you can only see those long-term structures if you collect and analyze data systematically. That's why record-keeping, automation, and iteration are not luxuries but necessities. What cannot be measured cannot be managed, and what cannot be tested cannot be trusted. It's tempting to believe that success in trading comes from brilliance. In truth, it comes from process. From the discipline to test hypotheses and discard what doesn't work. From the humility to know that every edge is temporary. From the patience to let statistics play out over time. The individual trade doesn't matter. The aggregate behavior of your strategy does. The trader who obsesses over the outcome of one trade is trapped in prediction. The trader who focuses on the performance of a pattern over thousands of trades is operating from understanding. In this world, the best insight often feels counterintuitive. For example, a strategy that wins only 51% of the time can make a fortune if the losses are smaller than the gains. A signal that appears weak on its own may become powerful when combined with others. Sometimes removing a variable improves accuracy. Sometimes adding randomness to a system increases stability. These paradoxes are what make markets endlessly fascinating, and why they resist simplistic predictions. Patterns over predictions is a mindset of learning. It's an admission that the world is too complex for certainty, but not too chaotic for discovery. It's a philosophy that rewards patience, precision, and open-mindedness. It doesn't seek to control the market, but to collaborate with it. To Find the hidden rhythms that repeat beneath the surface of volatility. And this way of thinking transforms how you experience success and failure. When your focus is prediction, a wrong call feels catastrophic. When your focus is pattern, a wrong call is data. The emotional volatility fades. The process becomes more stable, the decisions more rational. You are no longer betting on luck. You are compounding learning. Over time, these small edges, these marginal patterns, build into something extraordinary. The compounding of small advantages is the essence of greatness in markets and in life. You don't need to predict every move. You just need to recognize enough structure to tilt the odds slightly in your favor, and to repeat that advantage relentlessly, with discipline, for years. The beauty of this approach is that it scales with knowledge. The more data you collect, the clearer the patterns become. The more mistakes you analyze, the stronger your system grows. Every iteration refines the map. Every test strengthens conviction, not in a specific outcome, but in the reliability of your process. That is the true edge. Not prediction, but repeatability. To think in patterns is to respect uncertainty while still seeking meaning. It's to accept that while the future cannot be known, it can be navigated intelligently. It's to replace ego with evidence, noise with signal, drama with discipline. And perhaps most importantly, it's to understand that the goal is not to be right. It's to be consistent. So the next time you face the market, or any complex system, resist the urge to predict. Instead, measure, test, and learn. Look for what repeats. Capture what persists. Build from what survives. Because in the end, fortune doesn't favor those who guess the future. It favors those who understand the patterns of the present and quietly use them to shape their future. Discipline is the invisible force behind every lasting success. It does not shout. It does not seek attention. It works quietly, consistently, and relentlessly. In trading, as in science, discipline is what separates process from chaos, reason from impulse, and longevity from luck. Drama, on the other hand, is seductive. It thrives on emotion, excitement, and immediacy. The market is full of it, flashing screens, headlines, pundits, and panic. It feeds on reaction. The disciplined mind resists this pull. It acts deliberately, not reactively. It replaces noise with structure, excitement with patience, and hope with evidence. To trade without discipline is to enter a storm without a compass. Every gust of price movement feels personal. Every loss feels like failure. Every gain like victory. But the market doesn't care about emotions. It is indifferent. It rewards the disciplined observer who acts systematically, not the impulsive player who seeks drama. The great paradox of markets is that the more emotional energy you bring, the faster it consumes you. The more you try to dominate it through passion, the more it exposes your weaknesses. The only sustainable way to engage with it is through structure, through rules, data, and repetition. Discipline begins with an admission. We are not naturally rational. The human brain evolved to survive, not to trade. It seeks patterns in noise, comfort in certainty, and meaning in randomness. It fears loss more than it values gain. These biases are ancient and unavoidable, but they can be managed through process. The disciplined trader designs systems that protect against human weakness. Stop losses, position sizing, portfolio diversification, algorithmic rules. These are not just techniques. They are psychological armor. They exist to separate the human from the moment, to ensure that emotion never becomes the architect of decision. Drama feeds on immediacy. It urges you to act now, to chase what just happened, to react to every tick. But the market rewards those who can delay gratification, who can wait for confirmation, who can do nothing when doing nothing is the smartest move. In trading, patience is not passive. It's strategic restraint. It's the understanding that most opportunities are traps, and that true opportunity reveals itself through data, not adrenaline. Discipline is not rigidity. It is flexibility within a framework. It means having a structure that adapts but does not collapse under stress. A disciplined trader is not one who never changes their view, but one who changes it for the right reasons. Evidence drives adjustment, not emotion. Drama thrives on narrative. Discipline thrives on numbers. The disciplined trader asks, what does the data say? Not, what do I feel is happening? Every trader encounters moments of deep temptation. The urge to double down after a loss, to take profits too early out of fear, or to abandon a plan when it's temporarily underperforming. These moments test not your intelligence, but your emotional endurance. The difference between success and failure often lies in how you behave under stress. Do you follow your process or do you chase your emotions? Discipline means that your rules are stronger than your impulses. It's the quiet courage to do what your system says, even when your instincts scream otherwise. The market's drama is endless. Every day brings a new story. A sudden crash, a political headline, an economic report. Each event feels monumental, but in truth, most of it is noise. The disciplined trader understands this. They zoom out. They know that the signal lies in the aggregate, not in the anecdote. Drama magnifies the moment. Discipline measures the mean. One trades the news. The other trades the probabilities. To cultivate discipline, you must design your environment for consistency. You can't depend on willpower alone. It erodes under pressure. Systems must be automated where possible. Rules must be explicit, not implied. If your decisions depend on how you feel in the moment, you've already lost. The disciplined trader creates constraints that make good decisions automatic. Structure frees you from the burden of constant deliberation. It's not about control for control's sake. It's about creating conditions where rationality can survive emotion. Discipline also means understanding risk in a mathematical, not emotional sense. Most traders talk about reward. Few talk about survival. But survival is everything. If you stay in the game long enough, opportunity will find you. If you blow up, it doesn't matter how brilliant your strategy was. The disciplined trader thinks first about preservation, then about profit. They know that the first rule of compounding is not to interrupt it. Drama chases extraordinary wins. Discipline builds sustainable returns. The difference is time horizon. Drama is about today. Discipline is about decades. In many ways, discipline is the art of boredom. It's doing the same thing, the same way, over and over, with small refinements, without letting boredom tempt you into recklessness. Most people crave excitement. They want every day to feel meaningful, every trade to feel significant. But the market doesn't reward excitement. It rewards consistency. The best strategies often feel dull. They work because they are repeatable, measurable, and emotionless. Drama hates repetition. Discipline thrives on it. True discipline extends beyond trading strategy. It shapes your thinking. It means questioning assumptions, tracking performance, and learning continuously. It means accepting mistakes as data, not as personal failures. It means not confusing luck with skill. A disciplined mind is skeptical but curious, cautious but adaptive. It neither clings to certainty nor chases chaos. It seeks equilibrium. Drama is external. It lives in the flashing lights, the breaking news, the emotional highs and lows. Discipline is internal. It lives in your routines, your systems, your preparation. The trader who seeks external validation will always be unstable. The one who builds internal structure becomes independent of noise. Markets may fluctuate wildly, but their mindset remains steady. That steadiness is not indifference. It's mastery. Consider how discipline transforms decision-making. Suppose your model signals a trade that feels wrong. Perhaps the market mood is opposite, or the news cycle contradicts it. Drama would whisper, ignore the model, trust your gut. Discipline would say, follow the data, then evaluate the result. Over time, the disciplined approach outperforms because it replaces stories with statistics. Even when it fails transparently. The reasons are measurable. Drama hides behind narrative. Discipline exposes cause and effect. Discipline also governs scale. Many traders ruin themselves not because they're wrong, but because they're over-leveraged when they're wrong. Boredom as part of the process. The disciplined trader understands the best trades are often the ones you forget about because they follow the plan being dramatically right once. Drama seeks intensity. They think in terms of distributions, not single outcomes. The world celebrates dramatic risk limits, drawdown thresholds, the lucky break. These are expressions of discipline. These are statistical outliers. They ensure that no single decision methodical compounding of disciplined behavior rarely makes headlines. Discipline wants to win long, yet it builds empires. Discipline also demands emotional neutrality toward outcomes. A disciplined trader does not celebrate wins too much or mourn losses too deeply. They view both as data points in a larger experiment. Each result refines their understanding. Drama personalizes outcomes. Discipline abstracts them. The less personal your reaction, the more objective your evolution. This detachment is not apathy, it's clarity. It's the understanding that emotion is valuable in life but dangerous in markets. Emotion drives creativity and passion, but in trading it blinds you to probability. Discipline channels emotion into process. It doesn't suppress passion, it organizes it. To maintain discipline, you must embrace feedback loops. Track every trade, every decision, every deviation from the plan. Evaluate not only performance but process adherence. Most people measure outcomes. Few measure behavior, but behavior is what you control. Over time, disciplined behavior converges toward better outcomes, even if randomness obscures it temporarily. Drama resists measurement because it wants freedom without accountability. Discipline thrives on accountability because it converts data into growth. When you commit to discipline, you are choosing long-term autonomy over short-term excitement. You are choosing substance over spectacle. The market will still tempt you, with volatility, with noise, with stories of easy money. But you learn to see it differently. Every moment of chaos becomes a test of composure. Every panic becomes an opportunity to demonstrate stability. The disciplined trader doesn't react faster. They react better. And perhaps the most profound truth about discipline is that it compounds. Just as capital compounds through consistent returns, discipline compounds through consistent behavior. Each time you act according to principle rather than impulse, you strengthen the habit. Each time you resist drama, you weaken its hold. Over years, this creates exponential improvement, not through a single grand act, but through thousands of small, unexciting, correct decisions. Drama is seductive because it feels alive. Discipline feels still, but the stillness of discipline is not emptiness. It is focus. It is the stillness of a mathematician immersed in proof, of an engineer refining a system, of a trader observing patterns without interference. It's the stillness before precision. That is where real power lies, not in reaction but in control. The market will always offer drama, wild swings, emotional narratives, endless predictions. But if you can learn to rise above it, to anchor yourself in logic, to design and follow a process that endures chaos, you will begin to operate on a different level. You will no longer trade emotions. You will trade probabilities. You will no longer seek excitement. You will seek edge. Discipline over drama is not a slogan. It's a philosophy of survival and mastery. It's the understanding that success in complex systems is not about brilliance in moments of intensity, but about consistency in moments of calm. It's about choosing order over noise, precision over passion, and truth over illusion. In the end, discipline is the quiet engine that drives every durable achievement. It doesn't crave attention because it doesn't need it. It works invisibly, patiently, continuously, until one day the results speak for themselves. Drama burns bright and dies fast. Discipline endures. And in markets, as in life, endurance is everything. Every system in the world hides an imbalance. A small portion of causes produces a disproportionate portion of results. This principle is as old as economics and as universal as mathematics. In markets, it is even more pronounced. A handful of insights, trades, or strategies often generate the majority of all profits. This is the 20/80 profit map, a framework that teaches us to focus relentlessly on the vital few and ignore the trivial many. In trading, most people are busy all the time. They scan news feeds, monitor screens, chase signals, and react to every rumor. They equate activity with progress. But markets are not kind to motion without direction. The majority of effort in trading, like in most complex systems, produces very little lasting value. The art lies in discovering where the leverage truly is, which 20% of actions generate 80% of the compounding. This ratio is not just a mathematical curiosity. It is a mirror of reality. A few key ideas drive most breakthroughs. A few trades drive most returns. A few disciplined habits shape most of your edge. Once you recognize this, the goal is no longer to do more, but to do less, more precisely. The 20/80 profit map is not about limitation. It's about concentration. It's the geometry of efficiency, the science of narrowing focus until every unit of effort produces maximum output. The first step is measurement. You cannot improve what you do not quantify. Most traders do not know which of their actions truly matter. They may have dozens of models, strategies, or signals, but when they analyze performance, they discover that a small subset consistently outperforms the rest. The disciplined thinker isolates those drivers. They study why those patterns work, what conditions sustain them, and how to scale them without dilution. They refine the profitable 20% until it becomes the engine of the entire system. But the map is dynamic. The 20% that produces the majority of profits today might not be the same tomorrow. Markets evolve, relationships shift, and edges decay. The map must be redrawn continuously. That is why feedback and iteration are non-negotiable. Every trade is data. Every loss refines the coordinates of your map. The goal is not to find one eternal model, but to sustain a living process of optimization. A process that never stops asking which inputs still matter and which have lost their signal. The 20/80 profit map also applies to time. Not every hour is equal in value. Some periods, like high volatility windows or structural shifts, yield more opportunity per unit of risk than others. A disciplined trader allocates attention accordingly. Instead of being perpetually engaged, they conserve energy for those rare intervals where probability and payoff align. Most of the time, the correct move is patience. The professional's calendar is full of waiting, punctuated by decisive action. On the surface, this seems simple. Identify the profitable minority, discard the rest. Yet it is psychologically difficult because humans are drawn to activity and diversification. We fear missing out. We want to do everything. But in trading, as in mathematics, elegance comes from subtraction. Complexity is seductive but costly. Every extra parameter introduces noise. Every unnecessary strategy divides focus. The power of the 20/80 lens is that it forces you to strip away illusions of productivity and see the core mechanisms that actually drive returns. Think of it as energy distribution. Imagine all your capital, time, and cognitive bandwidth as resources in a closed system. If you spread them evenly, each area receives too little to matter. But if you allocate them according to proven efficiency, the 20% that truly compounds, the system becomes exponentially productive. The difference between linear progress and exponential progress is focus. The compounding of insight follows the same logic as the compounding of capital. Concentration accelerates growth. Dilution slows it down. However, concentration without feedback becomes fragility. That is why the map must always include a risk overlay. The same principle that amplifies profit can amplify loss if applied blindly. Diversification still has its place, but it should exist as protection, not distraction. The 20% rule teaches you to know exactly where your edge lies and to defend it with precision. Every position, every model, every decision must justify its existence through measurable contribution. Many traders believe they need constant innovation, new models, new tools, new ideas. Innovation is valuable, but only if it compounds what already works. Otherwise, it fragments attention. The disciplined thinker innovates within constraints. They ask, does this addition increase signal or just increase complexity? The answer determines whether the map becomes clearer or more confused. Progress is not the expansion of options. It is the refinement of understanding. In practice, the 20/80 profit map reveals itself through relentless analysis. You track your strategies, rank them by performance, and observe the distribution of returns. You may find that a small number of signals produce consistent profits while the rest merely add noise. When you cut the noise, your variance decreases, your capital efficiency improves, and your emotional stability increases. The market rewards focus because focus aligns your resources with reality. This principle extends beyond trading mechanics into mindset. 20% of your habits shape 80% of your results. The habit of recording every trade, reviewing every error, adhering to position limits. These small disciplines compound far more than sporadic bursts of inspiration. Most people chase new information. Few refine old wisdom. But the refinement of what already works is the highest leverage activity in any complex domain. The 20/80 profit map also reframes how you view losses. Not every loss is a mistake. Losses within your 20%, those that follow the process, are the cost of doing business. They are necessary data points in the model's evolution. Losses from the trivial 80%, impulsive trades, emotional deviations, speculative experiments, are pure waste. The disciplined trader distinguishes between informative pain and unnecessary pain. The map tells you where the cost of learning is justified and where it's just self-inflicted noise. There is another layer to the concept, the compounding of insight across dimensions. A single powerful idea can ripple through multiple strategies. One statistical relationship, when understood deeply, can generate a family of edges. That is leverage of thought. Intellectual 20/80. The more deeply you understand a few robust principles, the less you need to rely on superficial variety. It's not how many models you have. It's how fundamental your understanding of each is. The 20/80 rule also exposes the fallacy of perfectionism. In complex systems, you will never optimize everything. Trying to fine-tune every detail leads to paralysis. The wiser approach is asymptotic improvement, focusing on the few factors that drive most of the outcome, and accepting diminishing returns on the rest. This acceptance of imperfection is liberating. It allows you to invest energy where it matters and ignore where it doesn't. The map helps you know the difference. Many traders lose themselves chasing the next signal, the next trade, the next theory. They are constantly expanding outward, but mastery often looks like contraction, a gradual focusing inward toward the essential. The best systems in the world are deceptively simple on the surface, but backed by enormous rigor underneath. They contain just enough variables to capture the pattern, and no more. The 20/80 framework is an instrument of simplification, a way to extract elegance from complexity without losing power. To operate by this map, you must adopt a scientific temperament. Every assumption must be tested. Every belief must face data. The goal is not to be right, but to be repeatable. When you measure the results of your process, you start to see where the real leverage lies. You might discover that certain timeframes, asset classes, or volatility conditions account for the majority of your profitability. Once you know that, you can scale intelligently. Scaling randomness is dangerous. Scaling repeatability is wealth. This principle mirrors nature itself. In ecosystems, a few keystone species shape the stability of the whole environment. In music, a few notes define the melody. In mathematics, a few constants define vast structures. Markets are no different. A few recurring behaviors, human bias, institutional constraints, structural inefficiencies, explain most of the exploitable order. Understanding and exploiting these constants is the trader's version of mapping the DNA of profit. The 20/80 map is not static. It's alive. It shifts as liquidity, technology, and behavior shift. But the meta principle, that value concentrates, never disappears. It applies to strategies, time, attention, and capital. It teaches prioritization as an operating philosophy. When everything seems equally important, nothing truly is. The trader who tries to master every opportunity ends up mastering none. The one who narrows focus to a small set of proven edges builds depth, and depth compounds. There is a quiet confidence that comes from knowing where your edge lives. You no longer need to chase the market's drama or fear missing out. You know that your profit engine operates where probability and preparation intersect. You measure, refine, and repeat. This simplicity is not naive. It is earned through thousands of hours of analysis. Complexity becomes background noise. What remains is a clean signal. A few relationships, a few processes, endlessly iterated. The 20/80 profit map also reshapes your relationship with effort. It shows that productivity is not linear. 10 times more work does not equal 10 times more result. Once you've mapped the key drivers, the highest form of work becomes refinement, improving precision, reducing error, and protecting against decay. The marginal gain of optimization often exceeds the marginal gain of expansion. In other words, you grow not by adding more, but by losing less. Ultimately, the 20/80 profit map is a philosophy of clarity. It aligns trading with the deeper mathematics of asymmetry. It reminds you that not all trades, signals, or ideas are equal, and that wisdom lies in knowing which few deserve your full attention. It demands humility, because it exposes how much of what we do is wasteful. But it also offers freedom, because once you identify your true profit centers, you can let go of the rest without guilt. Over years, this philosophy compounds into mastery. The trader who spends a decade refining a few robust models will outperform the one who spends the same time chasing hundreds of shallow ideas. The one who studies their own 20% relentlessly will understand not just their edge, but its evolution. They will see patterns others miss because they are not scattered. Focus magnifies perception. Concentration reveals truth. In the end, the 20/80 profit map is not merely about trading. It's about how you allocate your life. A few relationships define your happiness. A few habits define your health. A few decisions define your trajectory. The market simply mirrors this universal asymmetry. The challenge, and the opportunity, is to identify those vital few and devote yourself to them completely. Because in every field where performance meets uncertainty, the same law holds. A small portion of disciplined insight creates most of the lasting success. The task of the rational mind is to find that portion, refine it endlessly, and let compounding do the rest. That is how intelligence translates into profit, and how focus transforms into freedom. In the end, mastery in markets and in life comes from clarity, not chaos. Patterns guide perception, discipline sustains progress, and focus multiplies results. The 20/80 profit map reminds us that success belongs to those who measure, refine, and persist, quietly transforming precision into enduring prosperity.